Right now, Wall Street is panicking. They're obsessing over temporary cyclical noise, and in the process, they are completely missing the impenetrable structural moat of what might just be one of the best businesses in the world. Today, we're looking at Copart. This is a company sitting on a multi-decade track record of compounding wealth, but right now, the market is pricing it like a business in permanent decline.
Just look at this massive valuation disconnect. Copart's normalized PE multiple has plummeted 39% below its 10-year historical average, recently hitting just 18.36 times earnings and hovering right near its 52-week low. But here's the central tension driving our whole analysis today. While that stock multiple is aggressively compressing, the actual structural demand for Copart services, specifically automotive total loss frequencies, is sitting at all-time highs. The business is fundamentally growing its total addressable market, yet the market is treating it like a value trap. So let's dive into this and figure out exactly what the market is missing.
To understand the mispricing, we first have to understand how Copart actually makes its money. It's a common misconception that they're just some massive car flipper. They aren't. Copart is a toll bridge. About 85% of their consolidated revenue comes purely from high-margin service fees. When an insurance company declares a car a total loss, Copart steps in and manages the entire chaotic process. First, logistics and towing. They dispatch a fleet to physically pick up the wrecked vehicle. Second, yard management. They store it in one of their secure physical facilities and handle all the complex DMV title clearing. Third, the global online auction. They list the car on their proprietary virtual bidding platform, collecting graduated transaction fees from both the buyer and the seller. And finally, post-sale value add, where they collect fees for loading and coordinating international shipping. They are literally collecting a fee at every single touchpoint without taking the inventory risk of actually owning the salvage cars.
So what is actually driving this economic engine? Why are there so many total loss vehicles feeding into the system in the first place? Let's take a look at the underlying structural tailwinds. This brilliantly illustrates the core growth driver. Back in 2019, about 19.5% of all auto insurance claims resulted in a total loss. By the first quarter of 2026, that number had climbed to 23.6%. That is a massive, permanent expansion of Copart's total addressable market. Why is this happening? Well, it comes down to vehicle complexity. Modern cars are essentially rolling supercomputers. A minor fender bender used to mean a $500 bumper replacement. Today, that exact same bumper is packed with advanced driver assistance systems, sensors, radar, cameras. Because of that, the average repair cost for a late-model vehicle has surged past $5,200. Add the rising adoption of electric vehicles to the mix, where even minor damage to a battery pack casing forces insurers to total the car due to complex liability risks, and you have a perfect storm. It is simply cheaper for insurance companies to write the car off, hand it to Copart, and let them auction it off.
Now, what's really fascinating here is the moat. Wall Street loves a good software moat, but Copart's moat is physical, and it is absolutely brutal to replicate. They own over 250 physical salvage yards. You can't just download a salvage yard, right? Securing municipal zoning permits near major metropolitan areas means fighting through strict environmental regulations and massive political opposition. It would take billions of dollars and decades of regulatory warfare to replicate this real estate footprint. On top of that, Copart's IT systems are deeply integrated with the claims processing software of the major insurance carriers. Ripping out that plumbing to switch to a competitor takes 18 to 36 months. And then you have the network effect. Copart connects domestic insurance volume with a huge global buyer base spanning over 160 countries. International buyers purchase more than a third of U.S. volume, which drives up average selling prices. Higher prices keep the insurance companies happy, which brings in more cars, which attracts more buyers. It is a textbook flywheel.
Which brings us to the central conflict of this whole explainer. If this business model is so impenetrable, and those structural tailwinds are so strong, why is the stock under so much pressure?
Well, the market is terrified of two things, and the first is duopoly pressure. The North American salvage market is basically a two-horse race between Copart, holding about 40 to 45% market share, and RB Global, formerly IAA, holding 35 to 40%. Copart has historically been the unquestioned leader in margins and tech, but recently RB Global has been aggressively upgrading its logistics. This tension boiled over when it was reported that Progressive, a massive insurance carrier, shifted a portion of its salvage volume away from Copart and over to RB Global. The market hates market share loss, and seeing a giant like Progressive move volume sparks serious fears that Copart's pricing power might be cracking.
The second fear is entirely macroeconomic. CEO Jeff Liao highlighted this dynamic perfectly during the Q3 2026 earnings call. Auto insurance premiums have skyrocketed. As a result, consumers are dropping their collision coverage or raising their deductibles just to afford their monthly bills. When a consumer without collision coverage gets into an accident, they don't file a claim. They transition to self-pay or cheap local repairs. That means fewer wrecked cars enter the insurance funnel, which means fewer cars are handed over to Copart. It's a cyclical squeeze on domestic volume. And by the way, if you like deep evidence-based stock breakdowns like this, make sure you're subscribed. Okay, so we have the fear, now we need the facts. Let's look at the hard financial proof reported on May 21, 2026, for the third quarter ending April 30, to see if Wall Street's panic is justified. The short answer? The business is an absolute tank. Despite the domestic volume drop, Copart reported Q3 revenue of $1.24 billion, beating Wall Street estimates by 3.33%. Fully diluted EPS came in at 43 cents, beating estimates by almost 5%. But the crucial point is exactly how they did it. Total unit volumes actually contracted by 2.4%, but Copart flexed its massive pricing power. Global average selling prices increased by 4.6%. That pricing power actually expanded their gross margins by 71 basis points, up to an incredibly healthy 46.3%. Breaking those numbers down geographically shows you exactly where the tension lives. The U.S. segment, feeling the heat from RB Global and those high consumer insurance premiums, shrank slightly by 0.3%. But just look at the international segment. It absolutely exploded, growing 14.1% year over year, driven by a nearly 6% jump in unit volume and massive growth in international service fees. So the domestic side is temporarily bruised by a cyclical macro event, but the international growth engine is firing on all cylinders. Now, let's step back from the quarterly noise for a second and look at a holistic, objective evaluation of Copart's long-term business health. Based on the research scorecard, Copart earns an impressive 8.2 out of 10 blended score, comfortably classifying it as a high-quality, resilient platform. Notice that 10 out of 10 for financial health. This is exactly what makes Copart so dangerous to its competitors. They are sitting on $4.2 billion in cash and zero long-term debt. This fortress balance sheet allows them to play aggressive offense while the stock is down. In the first 9 months of fiscal 2026 alone, they executed over $1.6 billion in share buybacks. They are literally eating their own shares at a compressed multiple. Management alignment also scores super high here with the return of Jay Adair to the CEO role. He holds over $1.9 billion in personal equity and takes a $1 base salary. He is deeply, deeply aligned with long-term shareholders. All of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, hidden gems, and dividend hunters. Portfolio Watch monitors your portfolio and flags important changes, and Insider IQ tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this explainer. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. All right, let's look at the financial modeling and see where this stock could actually go over the next 5 years. Before we jump into the math, I need to state clearly, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. Okay, we're looking at a 5-year investment horizon through the end of fiscal year 2031, starting from a baseline share price of $31.61. Let's focus on the base case, to which our model assigns a 50% probability. This scenario assumes a moderate 7.5% annualized revenue growth, bringing year 5 revenue to $7.17 billion. We assume net margins remain incredibly stable at their highly efficient 33%, and that ongoing share repurchases shrink the float by 1.5% a year. If the market eventually rewards that steady, compounding performance with a 22 times PE multiple, which, by the way, is still well below its historical average, we get an implied target price of $58.32. That is an 84% return over 5 years. But what actually has to happen operationally for those extreme cases to play out? Well, for the bull case to hit $98.36, auto insurance premiums need to normalize, bringing everyday drivers back into full collision coverage. We'd also need to see vehicle complexity push the total loss rate up to 25%, while Copart successfully defends its domestic moat against RB Global and scales its international footprint aggressively. That drives margins up to 35% and pushes the multiple back up to 28 times. Conversely, for the bear case to drag the stock down to $27.14, the current headwinds have to become permanent. Consumer premiums stay high, choking off volume. RB Global permanently steals massive chunks of market share, forcing Copart to slash its fee rates to compete. Margins compress down to 29%, and Wall Street permanently derates the stock to a 16 multiple. If you want to see all the detailed line item assumptions for these models, definitely grab the full report on Flash.
That bear case brings us perfectly to the real thesis-breaking risks that investors need to be monitoring closely.
What could genuinely break the Copart thesis? First is volume migration. Progressive moves some volume, sure, but if a titan like State Farm or Geico shifts a major account over to RB Global, Copart's fixed cost yard infrastructure will suddenly be incredibly underutilized, and margins will break. Second is regulatory threats. Electric vehicles are a great tailwind for total loss frequency, but they are a nightmare for storage. If governments start enforcing strict, highly costly hazardous waste mandates specifically for damaged lithium-ion batteries, Copart will have to spend massive amounts of capital upgrading their yards with specialized containment areas, entirely slowing down their processing speed. And finally, the ultimate long-term structural risk: autonomous tech. Right now, advanced driver assistance systems make minor accidents super expensive, which is fantastic for Copart. But if advanced vehicle-to-vehicle communication eventually eliminates a significant portion of traffic accidents altogether, the pool of salvage vehicles dries up permanently. Early warning signs to watch for? Keep a very close eye on Copart's pure sale mix. If that starts declining from its current all-time highs, it means auction liquidity is softening.
Let's bring this all together and resolve that huge disconnect we started with.
Here are the three main things you need to take away from this analysis. First, Copart's moat is physical, it's global, and it's highly insulated. The zoning laws, the 250-plus physical yards, and the deep IT integration create barriers to entry that new competitors simply cannot cross. Second, the current volume pressures dragging the stock down are primarily cyclical. High insurance premiums are forcing consumers to skip collision coverage, which temporarily chokes the supply of wrecked cars. But the structural trend, cars getting way more complex and more expensive to repair, remains firmly intact. And third, Copart is actively weaponizing its pristine, debt-free balance sheet. They are aggressively buying back their own stock at heavily compressed multiples, permanently increasing the per-share value for remaining investors. Wall Street is currently mispricing a temporary cyclical headwind as a permanent structural decline.
The real question now is, how long will it take for the market to wake up to the massive moat hiding in plain sight? Watch the upcoming Q4 fiscal 2026 earnings closely to see if those domestic salvage volumes are finally beginning to stabilize. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.